In this interview, we got an interesting topic. We are discussing with the head researcher for Wealth Research Group, actually. So we're going to have some fascinating things to talk about. We're here with Lior Gantz. We're going to be talking about macroeconomics. We're going to be talking about gold. We're going to be talking about silver. So first, if you are excited for this video, do be sure to hit the like button on either side just to send this out to more people. And today we have Lior. Now, also, you can check out Wealth Research Group in the description. He'll have a link where he talks about his playbook, and you can also check out much more on the newsletter to discuss gold, silver, and the markets. So thanks for coming on, Lior.
Thank you for having me.
All right,
Pleasure.
so let me ask you right away. So like from a macroeconomic perspective, right now there's so much going on. There's talks about more stimulus, of course, which there'll probably be many iterations of no matter who's president in 2021. And we're kind of just in this weird limbo where, you know, whether it's gold and silver, whether it's mainstream blue chip stocks, everything's just kind of in this no man's land pattern right now. Then we have all these interesting things going on in the economy with unemployment. What's your assessment on what's happening right now as just, first of all, as a citizen, but also as an investor and a researcher into these things? What's your assessment on what's going on right now in our world from a macroeconomic perspective and also from a nationalistic perspective as it pertains to, you know, America as us as American citizens, how it looks in our economy and such?
Yeah, great question, Jake. First of all, I'm not an American citizen, but
oh, wow, okay.
That will actually give you a better, not a better, but a different perspective on this, looking from the outside a little bit. In general, I think the big picture is that the United States economy came off of 2008, and it came off of it in a way that was centered around what the central banks were doing. So the government under Obama did not do a lot of fiscal policy. It left the heavy lifting, so to speak, to the Federal Reserve under Bernanke and then under Yellen to create an environment which makes investors and corporations feel safe and make the consumer come back after what happened in 2008. And so in the first few years, if you remember, between 2009 and 2011, you saw a boom in precious metals, a real boom. Gold surpassed 1,000 an ounce for the first time. Silver went up in crazy fashion. But because what the central banks believed would happen, which would be a trickle effect, where these corporations that got a chance to refinance their debts and take out new loans at very low rates, and household that had a chance to take out mortgages at very low rates, what they believed would happen was a trickle effect, where that newly created currency would trickle down to Main Street, from Wall Street to Main Street, and it never materialized. That blew up all this thesis about hyperinflation because of quantitative easing, and it created an economy where corporations and where wealthy individuals really enjoyed this world of zero interest rates, which benefited them a lot. But it created a situation where, for the average person, you saw stagnating wages for years and years and lack of participation in the employment market. You didn't see people come back to the employment market. When Trump came in, a lot changed immediately. With deregulations, and he brought the middle class back into confidence in America and in the American business machine. And you saw unemployment go to 50-year lows and even all-time lows. And it has a lot to do with, obviously, just demographic trends and things that are happening in general in the world, and not Trump related. But obviously, a lot of what he did created this environment. Because Trump has a very interesting way of governing the world's largest economy in a country that's very important for the world, with being about 24% of global GDP, he has a way of acting that is very different than other presidents. He can flick on the switch for a tariff war with China, for example, or have a government shutdown for a month and doesn't blink about it, go through an impeachment process. All of these things have created a situation, Jake, where investors, especially on the large scale, the sovereign wealth funds, the institutions, they kept a lot of cash on hand, because it's very hard when you have a president that has an idea and immediately implements it. It's that kind of an alpha male mentality to have all of your chips invested in one area, or to make a lot of to take a lot of risks. So in 2018, if you remember, the dollar, the US dollar, fiat currency, was the best performing major asset on planet Earth. The last time that happened before 2018 was 1969, 2 years before Nixon actually took the world off of the dollar standard, so off of the gold standard. So it's very important to understand that what Trump created inadvertently is a world with a strong gold, because people flock to safe haven, and a strong dollar at the same time. If you look at gold correlating with dollar, they're both trending up during the Trump years, and other fiat currencies are languishing. And so silver was a victim, so to speak, of the Trump years. The reason being that you saw the ratio creep up to 123-1. That's an all-time high for gold ounces divided by silver ounces. The macro environment that President Trump and in general that occurred in the last few years was that of a major boom around the world, which brought more and more people back. Now, a lot of people did not participate in the same way. So you see a wealth gap and an income gap in America, which is huge. If you take a cut of a random 1,000 people, the richest one is worth the combined net worth of the bottom 900. That's a very unique situation in such a developed country. And it's happening because of zero interest rates and because of this accommodative central bank policy. What COVID-19 has created since the pandemic is you see much more, and you will see much more in the future, fiscal stimulus. Fiscal stimulus is where the government comes in and says, hold on, central bank, I know you can print money, I know you can buy assets, I know you can buy debt, I know you can buy a lot of things, I know you can lower interest rates, but we can do many things as well. We can create incentive zones where there's no taxes. We can create fiscal stimulus programs like the PPP, like other aids. We can lower and hike taxes. We can do things that target Jake, for example, things that you can't do. By lowering interest rates, you can't target a specific demographics. By doing a lot of stimulus programs that are fiscal, for example, approaching banks and telling them to lower lending requirements for mortgages, you can spike the real estate market, for example. So in our world right now, the big change in macroeconomics is that governments are coming in. This decade, you will see fiscal stimulus alongside monetary stimulus. So it's a double whammy. That's not what happened during the 2010s, like between 2010 and 2020. And it will happen now. Why both? Because if you look at the national debt, if you go to usdebtclock.org and look at the national debt live right now, you will see that every citizen in the United States owes about $83,000 if you want to extinguish the national debt. And that is obviously racking up and unsustainable. When the government can't get enough income from income taxes and other forms of taxes, they have to go into deficit spending in order to create this fiscal stimulus. And so who buys that debt? Other countries and local investors from the United States. But if that's not enough, the central bank has to basically buy that debt. That is the lowest form, the lowest quality of currency issuance, because you're literally just faking new currency into existence. And that's what's happening. That's what is happening in the 2010s, but that will happen in much more pace in this decade. And so it changes a lot of the things you need to think about in terms of macroeconomics, because if the United States does it, you can bet Japan will do it, Germany will do it, China will do it, India will do it. A lot of these countries will say, I have legitimacy now. The United States is doing it, so I can do it as well. And that creates a world where you have a lot of money floating around, but you have the potential now for this trickling effect and a velocity of money. As opposed to the 2010s where you saw very low official inflation, you can see now increasingly higher inflation. And that is, I think, the big difference between what we saw in the 2010s to what we're going to see in the 2020s. The second thing, just very quickly, is that the millennials are a very different generation in the 2020s and the 2010s. In the 2010s, they were very young, just entering the workforce in their early 20s. Right now, they're in their early 30s. Most of them have to leave home, form families, buy houses, spend a lot, and they're in their peak earning years right now. They're entering this period where they're inheriting great jobs from retiring baby boomers. Very different mentality in America. Macroeconomic wise, I think we're entering a phase where the world, and especially because the United States is the world's largest economy, is moving into a phase where the fiscal situation will now prove itself to be unsustainable. Everywhere around the world, people will see that America's debt problem is out of hand, and it will just be like a bad marriage where the couple knows that something's wrong, but they're more afraid of a divorce. So you might not see the dollar lose its reserve currency status that quickly, but everyone will know that there's a problem with the dollar. And that is a big change between now seeing the world's the dollar being the world's best performing asset in 2018 to now seeing a very sharp devaluation of the dollar in the next few years.
A lot of interesting stuff there. So one thing that I've been thinking about and also listening to people's conversations is, of course, around the topic of inflation. And there was kind of two camps. There's the doomsday camp that says basically, Weimar Germany is coming, and those old clips that we saw from back in the day where people carried wheelbarrows full of cash, that's what's going to happen. And that is, we won't use any individuals' names, but that's what a lot of people that are big influencers have been saying for a very long time. And to the other camp, it's almost like the cry wolf situation too many times. And there's another camp of what I would call very on the polar opposite spectrum of that. And they say, there's no way we're going to get inflation. You keep saying it's going to happen and it's not going to happen. Now, you made a distinction where you said in 2010, 2011, I was a freshman in college, and you made that distinction where you talked about why we didn't get inflation then versus why you think we would get it now. And you talked about the velocity of money. And I thought that was an interesting point where you said the huge amount of money that was counterfeited into existence over the last while has been compartmentalized within a very select group of people. And it's really went into financial assets in the big companies to buy back their stocks, et cetera, et cetera. So it's stayed compartmentalized. And I thought that was an interesting way to argue that that's a reason that we didn't have inflation in the past. Now, why is it that people should actually care? Why do you think this time is going to be different? Because there's a lot of things I haven't made my mind up on, and I just judge both camps, and I don't care about every detail, and I entertain it. And so then there's the deflation crowd that says, no, we're not going into inflation. We're going into a total deflationary, the Great Depression times a million. Can you illustrate why you think inflation will happen now? Do we need to have direct deposits to consumers for us to get that type of velocity necessary for, I guess we'll make the distinction of price inflation, because there are, of course, Austrian purists that say, well, it is inflation no matter what. And maybe we'll make the distinction. One is currency inflation, pumping more currency, versus price inflation, where it actually affects your average millennial or your average 65-year-old trying to retire, real inflation. So why don't you unpack all of that?
Yeah, definitely. I think, first of all, that question is one of the best questions I've ever been posed. And I like that you're making a decision between a different types of inflation. So, okay, we did see inflation in the 2010s. We saw inflation go to certain things. Now, when people talk about inflation, they're more referring to broad-based inflation, where you just notice that in everyday items, not just in your tuition or rents in San Francisco or in a select group of stocks, etc. You see, where you're noticing that, hey, you tell your spouse or your mother, you know what, prices are rising here. You know what I mean? Everything I try to buy, it's rising, and that's what we call broad-based inflation. To get broad-based inflation, you need a couple of things. One, you need an increase in the supply of currency. That's happening. Two, you need wages to rise, and that's going to happen because what you're seeing right now in America is you're going to see a regeneration of new types of jobs. The world has changed in terms of the supply chain. So 80% of air conditioners are now made in China. That's not going to happen anymore. All this medical equipment that was made in China up until now, and we have to rely on it coming to the US, that's not going to happen. The US is changing the way it's going to consume, and it's going to be far closer to home using automation and robotics. You're going to see in the suburbs many new industrial complexes, not filled with people that are working low-end jobs, was with engineers and high-paid paying jobs, building all the infrastructure to do that. The world is changing because of COVID-19 to a world where you're going to keep a lot of that manufacturing close to home. And in order to compete on price with countries that are far cheaper in terms of labor, and by God, there's 49 countries that produce cheaper than China today. So there's a quarter of the world's countries that are cheaper than what China can do. When you want to compete with that, you need to create automation and robotics. And in order to do that, you need to have very smart people working on that. Smart people mean higher wages. That's what's coming. And I think with millennials, what most people fail to understand is that most of them are college graduates, and the median income for college graduates is 30K higher than non-graduates. So there's a lot of things that are happening that people don't take into account. What I think is very important is with regards to this deflation camp, there's a lot of things that we do today, like this call on Zoom, that are very deflationary if you want to spin it philosophically to say, 30, 40 years ago, this kind of call would cost us $1 a minute because you're in the US and I'm outside the US. We can take pictures today. My child is 4 years old. I've taken, probably 1 million pictures of her, and it cost me nothing to produce them and whatnot. So there is deflation in terms of there's a technological boom that makes our life much more comfortable, and it makes our life much more affordable if we want to have the type of things that people 40 years ago could not afford to have under the same wage or on the same salary. So that part of it philosophically is true. It doesn't matter in the big picture, because what you need to consider is just your salary compared to how much you can save if you want to have a normal life in your environment. The world in 2020 very different than the world in 1990, before we had many of the things that we have today. So, and then you need to look at what is inflation. So when I talk about inflation in America, I'm not talking about Weimar Republic. That was a different time. If you want to study that era, right after World War I, you're talking about a country that had to pay reparations, and it was divided in terms of its economy was dead. It literally was bombarded for 4 or 5 years. This is not where the U.S. was. Before COVID-19, before February, the U.S. economy was booming. It was booming. It wasn't booming, like I said, for everyone, but as a whole, as a country, as a machine, it was booming. And therefore, the trends are in place to continue that boom, obviously with the changes that are in mind. So when we talk about inflation, we have to think in terms of 2.5% to 3%, but with zero interest rates, that means that in real terms, you're losing about 3% a year on your purchasing power. The dollar is built to lose about a percent to 1.5% over time. If you look at 1971 until today, so 3% is doubled as fast as it usually loses its purchasing power. Now, someone may say, okay, well, what's a 1.5% compared to 3%? That's nothing. In terms of its nominal effect, it's nothing. But in terms of if you compound it to the entire economy, if an entire economy works on minus 3% a year, in terms of real terms on your bond yields, that is a huge difference. The world is mostly invested in bonds. The bonds market is the biggest market on the planet. It's worth around 25 to 30 trillion dollars. 17 trillion of that is in negative rates and in negative yielding bonds. You're literally lending a government money, knowing that in 5 or 6 or 10 years, whatever your bond duration is, you're going to get your capital minus they're going to charge you a fee for keeping your money for a few years. So when you have a world where that is the status quo for big money institutions, and now you're telling them it's going to go from -1 to -3, they may carry that risk and say, I'd rather have my money in gold. I'd rather have my money in other assets that are not going to depreciate at a guaranteed 3% a year like this does. So you saw the first part of this on April 1st, 2019, when the Bank of International Settlements, which is basically the central bank of central banks, changed the regulation on how much collateral gold can charge. Basel III regulations changed gold to a tier 1 asset. Until that time, only fiat currency in US dollar form and treasury bonds were tier 1, considered the best safe havens on the planet according to central banks. And you can charge collateral of up to 100% on them. Gold is now changed from 50% to 100% as of April 1st, 2019. Look at a gold chart. The gold's price was $1,291 an ounce on that day. So what basically central banks told you is, we believe that gold is worth at least double that because we're changing it from 50% collateral to 100% collateral. We believe it's worth double what it was on that day. So $1,291 times 2 is $2,584 an ounce. That's still about 22% higher than today. And that's the central banks telling you what they feel gold is worth. So the question of inflation has a lot to do with inflationary expectations. And when consumers now think that because of COVID-19, prices have had to come down because of the pressure on businesses, then they expect them to come up later on. With banks very different than in the 2010s, the banks were very strong coming into this. Bank of America, Chase, Wells Fargo, very strong financially coming into it. They didn't even need a bailout this time. Their lending requirements are very normal compared to the last time. And so many more millennials are going into the marketplace right now and looking for their first homes. I invest a lot in real estate. When I talk to big brokers, or big funds, the type that are Blackstone size, they tell me that there's a boom right now in single family houses around the country. And the part of it is because people want to move out of the city into the outskirts a little bit here. But it's more to do with just think there's a quarter of the country, 80 million people that have not bought homes, that are in their 30s and have not bought homes. That's highly irregular. So I
still rent. I mean, the only time I would probably buy a home is if I buy a sustainable property, if society keeps getting more and more unstable. But I'm one of those people that, I mean, I write it off through my business. I run my business out of my house for, my other business. And so, yeah, I'm definitely in one of those camps. And I have heard there are a lot of people that are around my age that are kind of starting to jump in, and they're saying things like, get in before it gets too high.
Yeah. So, well, who knows where prices are going, right? That's Warren Buffett has famously said that if an economist would whisper to his ear something, and if it was the Federal Reserve chief economist, he would just say, "You're interrupting me. I'm thinking." And also, he said every company that employs an economist has one employee too many. And so, forecasting, doing these types of prediction, Jake, you can. It's not the way to make money in the markets. You can't predict a script and then follow your own prediction, because it's just your own prediction. You have to live and breathe the markets and reality as it comes to you. So, and that's why opportunities need to come to you instead of you building like the scenario in your head, like the Weimar Republic scenario. That's a scenario. People just build it and then they aggressively do something towards that scenario. And that is not proven to be the best scenario. Just looking at facts, being 100% in gold has not been the best way to do it. What I've done, for example, is I've always compared gold to just fiat currencies. So if you look at 2000 until today, if you go to officialdata.org, you can actually put a dollar figure in there and see how much $1 in 2000 is worth today, for example. And you would see that it's worth 64 cents. So had Buffett not had a blind spot for gold, and he would have taken Berkshire Hathaway's shareholders' money, which he always parks billions and billions aside, and instead of just parking it in short-term treasury bonds, if he would have bought half of that position in gold, man, Berkshire would be $1 trillion company today, and not a mere 500 billion. He lost about 500 billion worth of shareholder wealth for having a blind spot. If you go to the year 2000 and look at what gold has done, it has been one of the best performing major assets in the world. Only REITs have outperformed gold in this new millennia between 2000 and 2020. Gold has beaten the NASDAQ 100, the S&P 500, the Dow Jones. Gold has beaten just about anything else that you can think of, obviously except for Bitcoin. And what I think the point is that you need to figure out your own risk tolerance. What I did is I took my family burn rate, a monthly burn rate. Let's say theoretically, just for purposes of here, it's $3,000. And I said, okay, what if there's a 2-year depression? What if there's a 24-month depression, Jake? So I took $3,000 times 24 months, and I said, well, I would need, if everything dries up in my life, I would need $72,000 in this kind of example to survive 2 years. So I took that fiat currency and I converted it into physical gold and silver. And therefore, that's my duffel bag. That's my start over fund, you can call it. That's how I know that, hey, if there's something real that happens, if this thing unwinds violently or something, not in terms of physical violence, but in terms of monetary violence,
right?
Disruptions in the market, if they close ADMs, if they do, the stuff that you hear on YouTube all the time.
If it happens in a doomsday economic crash as opposed to an inflationary scenario where things are a little calmer.
Yeah, if it's not orderly, if it's not a G7 meeting and let's reprice our bonds
right.
and let's talk about this. How do you get a haircut on your loss and you get a haircut on your loss? If it's something that goes out of hand, you have 2 years worth of fiat currencies converted into precious metals. Obviously, in that kind of scenario, the value of them even rises more. So you have more than 2 years worth of purchasing power because prices would come down in a situation like that. That is the base case. Now you have your security. So I have 2 years. Some people do 1 year. Some people do 6 months. The idea is you have that certainty now. And now when you look at the markets, you don't treat them like a casino anymore because now you have peace of mind. You know that you have a start over fund put aside. You can think about stocks. You can think about real estate. You can think about financial decisions in a much smarter way because you have that backup plan when it comes to your finances. Now, obviously, the best backup plan, Jake, is either a business that you own or a very indispensable skill. If you are an expert in something, then you would always have clients, and you would always write your own ticket in life because you have an expertise that's hard to copy or that is always in demand. So obviously those would be the two most important things. But other than that, obviously a savings cushion, specifically in gold and maybe a little bit in silver is critical. To me, silver is much more of a trade than a long-term hold. If you look at 1971 until today, it's 50 years worth of data. Gold is compounded at about 6.7% a year, whereas silver is compounded at far less. And so you need to think about that as well. Gold has acceptance in institutional level, whereas silver is accepted by the average person. And I think what's interesting about that is the average person makes decisions that are more emotional. And therefore, if he senses inflation in the coming years and, he has $300 or $400 or $500 saved, if he puts gasoline in his car and goes to the bullion dealer that lives next to his house, and the price is 30 an ounce for silver, and he has $300 and he can buy 10 ounces, that's fine for him. If the bullion dealer tells him you can only buy 9 ounces because the price is 35 an ounce, he will still buy it. That difference will not be a game changer for him. He will not say, no, you call me when it's 30 again. That $5 difference to an average person, it doesn't mean much because he has $300 to put to work. It's not like it's millions of dollars and there's a big difference. And then even if it's 40 an ounce and 45 an ounce, for most people, once you made that decision and you're fearful of inflation, you want to get your few ounces. So even if you can only buy 8 ounces or 7 ounces, that is a decision that I think most people will make. And that's why I think silver has that potential to go 30, 35, 40, 45, because for most people, that will not change their decision as if they already made that up before going to the bullion dealer. If you fear inflation, you will get some silver. That at least is what has happened in 2011 and obviously in the late 70s, the last 2 times that we saw a real problem with inflation. And then a lot of people say, well, you know what? Half of silver's demand comes from industrial companies. They won't be able to buy it at 50 an ounce. They'll say it's too expensive. They'll pressure the price down. Most of the thousands and thousands of industrial products that need silver, you're talking microdoses. So even if silver is 50, they will probably not even need to raise the price for the consumer. They will probably just offset that with other efficiencies in their production capabilities. Talking about micro quantities. You don't need to buy a bar of silver to create something. You buy a little bit and you put it in the cell phone, you put it in computers, you put it in solar panels, and a lot of photographical industries. But it's not a game changer, and that's why I like silver more as a trade, as a potential boom upwards. So that's a little bit about that, and if Biden wins the elections, I know that this channel is more about Trump, but I'm just saying if Biden wins the elections, it would have a very soothing effect on the relationship with China. Many institutions have parked trillions of dollars in cash because of Trump's head-to-head with China. If Biden wins, that will relax that and will weaken the dollar dramatically in the next few years. And that will actually work for both gold and silver. So a Biden victory, in my opinion, very bullish for both precious metals, whereas a Trump victory, more bullish for gold over silver because of the way that that the world is on edge when Trump is in power. And I love his accomplishments. I love that he says something and he goes and does that. But as a whole, CEOs of big companies, when they have to make decisions like moving plants from China or to China and everything changes on the daily, that is what has caused cash levels to be so elevated, Jake, in the last few years. So just a very contrarian view on Biden and Trump here, but I think overall, as long as interest rates stay super, super low, which I don't think is going to change, and as long as the recovery continues and you see more and more people go back to the workforce and we come down to those low single digits for unemployment rates in the United States, I see a -3% real rates environment, and that is unprecedented, and that will make the average person say, "I feel inflation," and that is what I mean. But when I say inflation, not doomsday, but just a general sense that something is wrong.
Yeah, interesting. I think that it's very clear no matter who wins, we're probably going to see a next iterations of stimulus. My guess is that they're going to be direct deposits to consumers and customers, no matter who gets in. Right now, everything, whether it's stocks, whether it's gold, and like we'll talk specifically gold and silver, has been in this kind of trading pattern, price pattern for gold and for silver. And then that brings in, the whole crowd that thinks it's about to sell off in the entire market run or bull run, and gold and silver is over. We're kind of in this weird thing with everything because America is in it's a really weird position to be in. And it's kind of a weird time because we're still, what's the 23rd, October 23rd is recording it. So we're still, a handful of days away, basically 2 weeks away from the election. And I think there's people all over that are, whether it's companies waiting on doing marketing budgets because they want to see if there's giant riots and things get worse, whether it's investors that are saying, I'd like to buy gold or silver or Bitcoin or real estate, but right now I'd like to see what happens over the next 1 month or over the next 2 months. Where do you stand as it pertains to gold and silver and the stock market? Do you think that, you discussed that you think predictions are a fool's game? Do you think that the case is warranted by individuals that are saying the gold and silver run is over, or I'm not buying any right now? Or do you think that that's an unwarranted claim no matter the circumstances?
Well, first of all, go back to what I said about a start over fund or a duffel bag approach. And by the way, we wrote about gold and silver like in a comprehensive way. If you go to wealthresearchgroup.com/gold playbook, that's where you can download like a PDF report about all of this. And what our thinking is that the gold is compounded in this millennia of low interest rates at a very fast pace. We don't see that changing that much. There is no reason to believe that the case for gold is over. Now, in 2011, when you saw it go up from 850 to 900 to 1900 an ounce in a matter of 18 months, that's something different. But if you look at measures of how much it covers of the currency supply, it's at an all-time low. So gold at the official reserves level for the United States compared to the amount of currency is right now at about 5.5% to 6% of the currency supply. In other words, in 1980, for just a few weeks, when gold was trading at 850 an ounce, you could have taken all the gold ounces that America officially, the United States officially says it has, sell them at the open market and close the entire national debt. You covered the whole currency supply at 850 an ounce in 1980. It covered 100% of the currency supply. Today, it covers 6% of the currency supply.
Whoa.
Yes, a light gold standard. So a very light gold standard is considered 20%. So 20%, you would take gold's price today and you would triple it. And that would be around $5,700 an ounce. If you take the classical gold standard of 40% of the currency supply, well, you would need to multiply gold by 7. So 1,900 times 7, you're almost touching 14,000 an ounce. And that's at 40%. If you want to go to 100% of the currency supply, which you saw for 1 or 2 weeks over there in the late 70s when it really spiked at the end, well, you would need to multiply gold's price by 16. And that's how people get to those $30,000 an ounce predictions, because it just doesn't cover a lot of the currency supply. Only 0.5% of the asset universe. In other words, if you take the equity of all the stocks, all the bonds and real estate that people invest in, and you would take the amount of gold that people invest in, it would cover only 0.5%. That means that out of $1 billion, for example, not even 1% of that, so not even 10 million of that, is invested in gold. It's only 5 million out of every billion, only 5 million. In 2011, for example, it was 0.85%. So you would have a 60% jump from here. 60% jump from 1900, or let's round it up to 2000. You would still see 60% return from here, and that would mean gold at $3,200 an ounce. Now you have to consider that with wages being as they are, and with oil prices being low, the mining industry is becoming so profitable, it rivals software, it rivals tech. So you would see amazing returns for mining companies if you have a world where right now the AZAC, which is the all-in sustaining cost, is about $975 an ounce for gold, whereas gold is trading at about $1,975. So the margin there is $1,000 or 100%. Ice cream parlors can make 100% on selling milk. You know what I mean? It's on selling iced milk. It's very profitable right now. And I think that's also something to take into consideration, how you look at aside from spot price, right? Spot price or the duffel bag approach, that's just for safety. If you want to look for gains and to make huge profits or potentially huge profits, you need to look at the mining companies. Now, if we, for example, if we say that a gold bull market is between 5 to 10 years and gold bottom in December of 2015, we're already almost 5 years into it. So what I look at is either producers or companies that have a chance to sell to a producer, but in the immediate term. And so if something has a long development process, that's something I'm not interested in right now, because of the cycle, because of how long the cycle could last. Because at some point, gold becomes expensive enough that not the people that buy this duffel bag approach and just have it there forever, but the traders say, oh my God, I can sell this thing, I can move it into an alternative equity otherwise that is more attractive. So there's a price there. There's a price somewhere in there that is the top. That is where the buyers of sell and the sellers, just the market forces say enough is enough. That is the fair price of gold for this time, or for this day and age. So that's basically what I think in general. And, if you look at how gold is getting treated by central banks, they have been net buyers of it for the past few years. And that is a very important distinction, because in previous decades, they were net sellers. They were selling their gold and trying to basically suppress the price of gold by selling it, creating artificial supply. Now they're buying it. And so they're competing with you for its price. They're creating demand for it. We've hit peak gold production in 2018. And so the global production of gold is going to have, meaning be half of what it is right now by 2024. And so the last 3 times we saw peak gold, let me tell you, 1970 and 2000, right before the best 2 bull markets for gold. So I know supply and demand doesn't play a lot of role for many people with gold, because they say, well, the supply is always there. It's all the gold we've ever mined is above ground. It's sitting in the hands of someone. That's true. Unlike silver, which gets wasted and you can't recycle the whole thing. Gold is somewhere, but it doesn't mean that somebody would sell it to you at the price that it's trading right now. So supply has a lot to do with it. And if mines cannot produce as much as they did before, that creates another constraint on the price of gold. And like I said, 1970, 2000, and 2018, peak gold productions. So that's important as well. And that also plays into our thesis. And, in our newsletter, we cover both this macro picture, but also specific opportunities in the mining sector. And, in the last 18 months, we've seen 7 companies that have done triple digits in the newsletter, in the free newsletter. So there is the opportunity there if you know what you're doing. And I think we are in an uptrend. What's the downside, or what's the case against gold and silver? Well, one camp of people, they say, look, we're in a recovery. The worst of this coronavirus is over. The vaccine is coming. And so all the people that bought on fear, they're going to sell. It is true that we're not in March anymore. This is not the circuit breaker week where everybody panicked. But the case for gold has been true for 50 years. It's not going to change because they're not panic. Panic helps gold short term. Long term, you have seen the collapse of fiat currencies around the world. The system of fiat currencies on a global scale has proven itself to be inefficient for savers. All governments are basically signaling to their citizens, we have a medium of exchange that we're taxing you on. What is losing 36% in 20 years in purchasing power? That is putting $100 in your pocket in the year 2000, where it would have bought an X amount of merchandise, and now it can buy 0.64 of that same merchandise. So they've taxed you 36% for saving money in 20 years. It's a tax. Inflation is a tax on you.
Right.
So you can hedge that tax by buying either cash flowing properties or cash flowing companies via stocks or private businesses that are able to meet that inflationary pressure and raise their prices or raise their efficiencies, grow their market share, etc. Or you can buy gold and silver. That's what has proven itself to be useful. So,
and I like what you said also, and I think it's a great place to wrap up. And I think it's important for people to be considering is, as you said, business as an additional, not only hedge against changes in our world, but as probably the most historically universal way that individuals have been able to achieve financial freedom. So I really appreciate your time today, Lior. I got to go take my 12-week-old daughter to the doctor's appointment. Thank you so much for your time. We have the Wealth Group research in the description right there down below. That was truly fascinating stuff. And if you enjoyed this video, which I'm sure you got a lot of value out of it, do make sure that you hit the like button on either side to send this out to more people. We need as many people in the world to recognize what's going on, so as many of us are prepared as we possibly can. And if you learned something from this that was really valuable, please leave a comment down below and let us know what your biggest takeaway was from this interview. And thank you for joining us.